welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Thursday, May 5th. Happy Cinco de Mayo. And I am pre-recording this Trading Places Live for just a little bit later this morning. Currently, we got futures turned around a little bit, pointing negative after a very strong afternoon on Wednesday after the Fed met and announced a 50-point basis hike as expected. But there was a little bit of language later on after the announcement where Fed Chair Jerome Powell indicated that the Fed would not get more aggressive than the 50 basis point hike, which I'm not sure I would have gotten that excited about. But anyhow, the market did have a huge rally after that particular statement was made. So we saw the market rally into the close yesterday, but where are we going to go from there? Well, currently futures are down. We've got Dow futures down about 185 points, S&P 500 futures down 31, NASDAQ futures down 120. Still got a couple hours till the market opens, so lots of things can change, but at least for now, it does look like we'll get off to a weaker open this morning. Let's go through the agenda for today. So I'm going to start off with your daily market recap. Then we'll get into talking technically, break it down, take a look at the technology sector, the industry groups there, then earnings spotlight, and finally we'll wrap it all up with the 3 you must see, featuring 3 companies didn't fare so well on Wednesday. We'll take a look at their charts and see if there's any hope there. Before we get into any of that, let me take you over to earningsbeats.com. For those of you that are new to Earnings Beats, if you go to earningsbeats.com, scroll down, we have a free newsletter. We'd love to have you join. It is published 3 times a week, Mondays, Wednesdays, Fridays, normally out by about 8:30 in the morning, usually a solid hour or so before the market opens. All it takes is your name and email address. That's it. No credit card. You can unsubscribe at any time. Simply type in your name, email address, hit that subscribe button, and we will get you started. All right, looking at the market action, let's jump into the daily market recap here. So it was a really strong final hour and 15 minutes or so on Wednesday. And it was interesting because when I did my show Wednesday morning at Earnings Beats, for those of you who only listen to my show here, at StockCharts on Tuesdays and Thursdays. I also do a live show from 9 to 9:30 at at Earnings Beats on Mondays and Wednesdays. And when you're over, all you have to do is go over Earnings Beats after about 8:45 in the morning Eastern and click on Trading Places Live. Currently, because I'm not preparing to do a live show there, you're going to see the recording. So this is the recording that I did on Wednesday from the show I did on Wednesday. But if you go in on Monday and Wednesday between 8:45 and 9, or even if you come in during the show after 9, there will be a link that you can just click on and come right into the room. So if you do like these shows here at StockCharts, Trading Places Live, and you want to view on Mondays and Wednesdays, go over to earningsbeats.com. It's a free live show. Anyhow, one of the things I was talking about on Wednesday was I was really surprised that we didn't get more of a bounce on Tuesday. Remember, Monday we had the big reversal, had the VIX go up over 36, and many times you'll see very, very quick snapback rallies like we saw back here at the end of February, huge move down, and then literally like the next day. And that's kind of typical of many cyclical bear markets. When you go through these periods of high volatility and a steep price drop, many times you get really quick 2-3 day bounces. And so I was kind of disappointed on Tuesday that we didn't see much reaction. After the big move down, you can see we actually took out these prior lows on all the major indices except the Dow, almost did it on the Dow. But you see the lower low on the S&P, the lower low on the NASDAQ, lower low on the mid cap, lower low on small cap. When you generate those new lows, you're getting a lot of stops being triggered. And if market makers are actually buying, if market makers are buying into those intraday breakdowns, usually because they're on the long side, normally you'll get that quick snapback rally. And again, Tuesday, we just didn't see that. And so I was a little disappointed, but I had said yesterday morning, maybe we'll see it on Wednesday. Well, the Fed meeting came and went, And for the first half hour or so after the meeting, still nothing. In fact, the market looked like it was rolling back over. And then these comments came out about how the Fed was not going to get any more hawkish than they already are. Well, they've already announced they're going to raise rates 9 times. And I think 12, including 3 next year. So, I'm thinking we've already got the GDP, which has gone negative. The initial reading of Q1 GDP was negative, which is halfway to a recession. Was there anybody really thinking that they were going to get that much more aggressive? But anyway, that was the excuse that was used, that, hey, the Fed's not going to get more aggressive. This is the worst it's going to get, 1/2 point rate hikes. Oh boy. Anyway, stock market took off and we saw a huge rally, big rally. I'm talking the NASDAQ, which was down close to 100 points after the Fed announced, a half hour after the Fed announced, it was down 100. It finished up 400. That's a 500-point reversal in a little more than an hour. I mean, it was a big deal. We had a huge rally. I don't know that it's going to stick. I think we're still in this volatile period. We'll see. I mean, we got futures down, but maybe we rally right back up after the market opens today. We'll see. And maybe we rally back before the market opens. Who knows? We do have initial jobless claims coming out later this morning. That we'll see that before the market opens. Maybe something there sparks some buying. Who knows? Anyway, when we look at the action from Wednesday, it was solid, but we're still in downtrends. Remember, we did this when we bottomed in February. We did it when we bottomed in January. Quick recoveries, these quick recoveries. Here we did it again yesterday, quick recovery. Is the downtrend over? I'm not ready to write that off just yet. Anyway, Dow Jones finished up 2.8%, almost 1,000 points, 932 points. S&P 500 up 125, almost 3%. NASDAQ, as I mentioned, up over 400 points, which was more than 3%. Mid caps up 71, a little more than 2 3/4%. And small caps up 33, which was about 2 2/3%. Really strong across the board. Almost all the different areas or all the different indices in the market up anywhere from about 2 2/3% to about 3 1/4. Strong day. Looking at the sectors, all 11 sectors were higher. So there were no laggards, at least none in negative territory. Energy led, gaining more than 4%. Technology, 3.5%. That was good to see, watching technology. Got back through the 20-day, by the way. But we did that a couple of times back in February. We also did it again at the end of March. So this doesn't necessarily mean we're out of the woods, but it's better than being below the 20-day. So I thought I'd point that out. Communication services up 3.4%, materials 3.25%, financials a little more than 3%. So again, very, very strong day. Possibly we'll get some more follow through, but I'm not sure I'm buying into the reason for it. Yeah, I'm of the opinion the Fed is going to not be nearly as hawkish in the end as they're talking. You have to understand one thing about the Fed. They psychologically sometimes will try to get things to happen in the economy that they want to happen without actually, forcing their hand to do something. Think about the entire secular bull market and how the Fed has basically been there every step of the way saying, hey, if the economy falters, we're going to be there. We have tools in the tool chest. We will make sure that the economy remains at least positive, strong. That's what they've been essentially saying for the past 8 years, 9 years, since we broke out in 2013 above the 2007 highs, since the days of the financial crisis, quantitative easing, TARP for the banks. Remember the TARP? Of course, that was more government, rather not the Fed. But all of these different things, the Fed has been ready to step up for the stock market. They're hawkish now. They know that they've got inflation that they've got to make sure they keep under control. Well, one way to keep inflation under control or to get it under control is raising rates. And another is talking tough. And just being there and saying, hey, we're going to raise rates till the end of time if we have to, just to let the market know that they recognize the problem, they're going to solve the problem. And that in turn helps the stock market. Sometimes all they have to do is just say they're going to do something. They don't always have to follow through. The trade war of 2018, remember, Fed Chief Powell came out and said they're going to raise rates twice. That was back near Christmas of 2018. I wrote in my blog, they are not going to raise rates. The next move the Fed made, I think it was in July of 2019, they cut rates. They didn't raise them. Sometimes they just say things. So, be careful. They're not always going to do exactly what they say. I will be shocked. I will be one of those that are shocked if the Fed has to raise rates 9 times, 12 times, whatever. I think we've got a CPI report coming out on Wednesday, May 11th. That's going to be below. It's going to actually bring the annual rate of inflation down at the core level. I'm talking about the consumer price index. So the core CPI on an annual basis, I believe, is going to drop not only next Wednesday, but probably the next 3 months, because the readings that are coming out the next 3 months, we've got the April, May, and June readings, which will be published in May, June, and July. Those 3 readings from last year were extremely high. So the readings this year are going to replace them. Unless we have CPI, core CPI numbers around 0.8% or higher, we're going to see the inflation rate drop. We also have our first GDP reading that was negative, halfway to a recession. Take the combination there, and already we had deteriorating sentiment. We've had that for the last year or over a year. All of that combined, I don't think the Fed's going to need to raise. We might get one more. I don't know. I think we might get one more. But I think by the time they raise again, we're going to have 2 more CPI reports before the next Fed meeting. So if that shows inflation coming down, if they do raise, they might say, well, we see inflation coming back down a little bit. We're going to go ahead and raise, but we're prepared to stop if we need to. I expect language to change at the next meeting. And probably between now and then, I see the market bottoming. We'll see. Anyway, long dissertation there. Let's keep moving. Got a lot to go over here today still. 10-year Treasury yield. So yesterday we did pull back about 4 basis points. If we do see that lower than expected inflation reading next week, I just want to point out one thing here on the 10-year Treasury yield. If you look back to the high, here we had a big move up, and you see this high, and this high. Well, this high and this high saw higher PPOs. This one did not. So this is where we've got a negative divergence. See the higher prices and the lower PPO? And guess what? We had a period of weakness here that took us back down to the 50-day, a little bit below the 50-day. And we didn't break back out above that high for 2 or 3 months. And then we started rallying again. This high and this high, higher PPOs. Then when we broke out and put in this high right here, we never took out that prior high. Negative divergence. What happened? Period of weakness, down just below the 50-day. Now let's look at what's going on here. Higher, here's a move up. There's your PPO, higher high, higher PPO, higher high, higher PPO, higher high, oops, lower PPO, negative divergence. Well, the last 2, we saw this pullback and this pullback, both below the 50-day. Right now, the 50-day is sitting at 241. We're at 292. I'm not saying we're going to go back down to 241. The breakout that we haven't retested those at 250. I wouldn't be surprised maybe over the next couple of weeks if we got down to 250. That could spur the market higher. Lower rates. We'll see. You can see here we spiked in February, came back down. Now remember, we were coming down here and it was February 24th we bottomed, and we had a couple-day rally, or a little bit more than a couple-day rally on the S&P 500, and that coincided with rates dropping. Now back here when we topped and pulled back here. It was right around this time, middle of November. That's when we saw a lot of growth stocks in technology and consumer discretionary either top or approach a top, right, in this time frame. So we've suffered through a lot with rates rising in those growth stocks. If we get a temporary pullback, that definitely could certainly help us in the short term with growth stocks. Maybe we do rally a little bit further. You know, the more I look at this, if we get that pullback in treasury yields, that certainly would be a catalyst that could drive the market a little bit higher in the near term. But I don't think we're over yet. And that's because we haven't seen enough rotation on this move down. All right, let's move on to talking technically. And here I just wanted to show you the S&P 500. Here are the lows, the key lows over the last 6 months, right here, 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 right in here, again, just this week. Maybe throw in one over here in December. And I want you to look at the VIX. When we hit this first bottom, the VIX hit 29. This bottom, VIX was 25. This bottom, the VIX spiked all the way up to 35. This bottom, the VIX was over 27. Here, 39. Here, 38. Here, 37. Here, 34. Here, 37. These moves, I mean, I'm not making this up. When we get the VIX up into the mid 30s, and this isn't just this year, during secular bull market pullbacks or even corrections or even cyclical bear markets within secular bull markets, getting that VIX up into the 30s is normally a good time to think about entering in. And it's hard to do it because when the VIX is shooting up to 35, 36, 37, 38, that's when the market is kind of free falling. And it's not easy to hold your nose and buy stocks when everything is selling off hard. But if you go back and you study history, this is when the best times to buy are. Now, I would, go on further to say the VIX can go up into the 40s and even touch 50 during these cyclical bear markets. So, and trust me, if we go from 36 on the VIX to 50, we're probably going to lose 10% on the S&P 500. You don't just slowly meander lower when the VIX goes from the 30s to 50. That is normally an impulsive bout of selling. We're talking fear, panic, throwing the kitchen sink out, the baby out with the bathwater, anything you can come up with there. But that usually accompanies that kind of volatility. So 25 to 35 will generate some selling. 35 to 45 on the VIX, look out below. And so that's the scary part about buying when it's at 35. You might be a little premature. But what I've been talking to Earnings Beats members about is using volatility as your friend. And as the volatility spikes, begin to build back into positions. If you sold back in the beginning of January when I said I thought the market topped and I thought we were going significantly lower to start 2022, if you got out of the market, I would be using these high VIX readings to get back in. All right, let's move on to break it down. So I wanted to start here with technology, just the XLK. And you can see, here's the trend lower down, rebound, back down again. Double bottom, I mean, we went a little bit lower, but maybe a double bottom here. We'll see whether or not we can hold. It would be bullish to go back up and break out above this triple top. That's all the way back up at 164. Even after yesterday's huge rally, we're still at 148 and change. A lot of work to be done. We've got gap resistance coming in at 153, prior high at 153, the 50-day moving average at 150 and change. We got work to do. I don't believe we're going up and just breaking out. I don't believe we're there yet. I mean, we're close. I would really like to see one more scare, one more move down in the market to really flush things out. And I'd love it if that move to the downside accompanied with relative strength in areas like technology. So we're not quite there. Here we're seeing a little bit of strength as technology bounces off of this low right here. It's not overly surprising when you bounce to see a group like technology bounce back. So that's a good start. But can we get back through this high? Here's the high, come down. There's your low, lower high, lower low, lower high, lower low. Right now, lower high. First step is to get the relative strength back up above that level and getting absolute price action back up above that triple top. And as I said, we got a long way to go. So that's where technology looks right now. Now, if you go back, this is a 5-year relative chart, technology. And if you look on, and this is a weekly chart, but if you look this rally back, this is where we've been struggling in 2022, is when we get that relative strength back to or near the declining 20-week moving average, relative 20-week moving average. So until we can break that, get back through both these moving averages, that is, I would continue to be cautious. The rallies are nice, but you got to be cautious. Now, to the downside, if we keep selling off, I would think if we get back to this low right here, we would be at, getting close to a 2-year relative low in technology. That would start to scream to me that it's time to maybe think about getting in. So anyway, something to think about there. Moving on. So let's take a look at the industry groups within technology. And this is a 3-year relative chart of each of these industry groups relative to the S&P 500. So here's computer services, right here, computer services divided by the S&P 500. So you can see it's been underperforming for 3 years and still not really doing anything. Lately, we've had a little bit of strength, but we've seen that plenty of times before. Nothing that I would write home about at this point. So I see weakness, relative weakness still in computer services. Semiconductors, okay, we're getting a nice little rally here on a relative basis last week or so. That's good, but we're still in this downtrend. We're still below the moving averages. The relative PPO is as weak as it has been at any point over the last 3 years. In other words, relative momentum remains very weak, and we're barely budging back to the upside here. So is this going to last? I don't think so. I would be very surprised. One side of me hopes that we bottomed and semiconductors start leading again. But the other side of me says this is probably not how the bottom is going to form. Probably need one more move to the downside. Software. Software is already broken beneath that low, relative low that we saw at the beginning of May of 2021. So here we are a year later. We're about where we were in May of last year. We had the huge rally last summer into early fall, and then the big decline. And now we're right about where we were 1 year ago. But we're still in a relative downtrend. We're still in an absolute downtrend. So really like to see some more positives coming out of here. I'm not ready to call bottom. Then we got electronic equipment, which is rolling back over again, been in a steady downtrend since August of last year. Really looking poor right now. Can't really recommend that group. And we got computer hardware. This is Apple's group. So Apple continues to hang in there. This is one part of technology that continues to look strong. Here we are at an all-time relative high, despite everything going on in the market. Now, on an absolute basis, we've got more consolidation going on, but in this market, consolidation isn't bad. If you've just been consolidating the gains you made in the prior couple of years, that's good compared to what everybody else is doing in this market or every other area of the market's doing. So computer hardware, I think, still looks pretty good here. Then we've got electrical components and equipment. Well, that's been going down, rallying back up here over the last couple of weeks, few weeks maybe, but we had taken a hard hit. So I think this is a nice relative rebound, but still a lot of work to do. You can see on an absolute basis, still in a downtrend. Telecommunications equipment, had the huge move down back in 2019, 2020, bounced back a little bit through 2021. Now we seem to be rolling back over again. That group seems to be struggling, and I'd really like to hold this relative support here at about 0.34. The last one is renewable energy. So we actually had a bottom back in January on a relative basis. Now, actually on an absolute basis as well. I was thinking we had broken back down again. So far, we're holding 160 on renewable energy. That's a level to watch. The relative strength has picked back up again, but we've seen that before. We saw that last year, September, October, and then we fell apart again. So nothing saying we couldn't fall apart here. I'd watch on an absolute basis, 160 to the downside, 200 to the upside. Let's see which one breaks first. But that's it. There's your technology and all the industry groups within technology broken down step at a time. Nothing really looks great there except for computer hardware. And you can thank Apple. Apple has held up very well throughout all this weakness in 2022. I mean, look at all the FANG stocks. Many of the FANG stocks getting beaten up pretty bad. Apple has held up. Apple has been a very good performer. All right, earnings. So let's talk a little bit about earnings here for just a minute. A couple of not so great reports yesterday. And so let's go over a couple of these. One is Etsy. Let me give you the numbers here on Etsy. They beat 60 cents versus 59 cents, but it wasn't enough. So pre-market, well, I'll tell you, booking pre-market was looking pretty good this morning. They blew out earnings. I mean, huge beat. Etsy, though, is down $13.50 this morning, down 12%, 95.84. So yesterday's range, the low was 96.10, and then we went all the way up, finished at 109. They had their earnings and right back down to yesterday's low, actually slightly beneath it. Not good there. Another company that came out and reported was Twilio. They were expected to lose 23 cents and they broke even. I thought it was a decent report. The stock initially and after hours was down 20 bucks. It was down to 98. And then throughout the next 30 minutes or so, maybe not even that long, maybe 15 minutes, it completely reversed and went positive. So that's how volatile after hours action can be. So you got to be careful there. Another company that reported, let's see. CF, this is one in the material space. They just matched expectations and the stock's been going up a lot, but still it's up about half of $1. So CF looks pretty decent as we prepare for this morning's open. Anyway, those were just a few that caught my eye. There were a lot of different reports out yesterday. Yesterday and today, by the way, the two heaviest volume days in terms of company earnings reports. So a lot going on. All right, let's take a look at the three you must see, and then we will wrap this up. I'm going to start with Akamai. Akamai, big gap down, held prior support though, and a big reversal. Look at the AD line breaking out. Interesting stock. Anything back down near 97.5, 98 would be very interesting if it pulled back to that level. JCI, this is Johnson Controls, been trending lower, gap down, another one with the big recovery, a big hollow candle. But again, everything was being bought yesterday afternoon. Keep that in mind. The AD line, even though yesterday we had a surge, not nearly as strong as we saw on Akamai. And then the last one I have here is IDEXX Labs, IDXX. Again, another one, AD line, not very good. Price action, not very good. Gap down, big reversal. Probably as it gets back close to price or gap resistance, may see some more sellers come in. All right, that's it for me. Appreciate everybody tuning in. Have a great day, and I will be back next Monday at earningsbeats.com. Have a great day. Have a great weekend, everybody. Be safe. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.